Gold, the shiny metal that promises security, stability, a hedge against chaos. Right now, it's hitting levels we haven't seen in decades, record after record. But here's the twist. The very reason gold is spiking might be the exact signal that trouble is brewing. Peter Schiff, the economist and gold bull, isn't just raising eyebrows, he's sounding alarms. And if you ignore what he's saying, you might be walking straight into the next financial storm. In the next 45 minutes, we're going to unravel what's really happening behind gold prices, why it matters to you, and why this isn't just another headline, it's a warning buried in numbers. Let's set the scene. The year is 2026. Inflation numbers look like a roller coaster. Markets are jittery, and central banks are dancing between raising rates and printing money. Meanwhile, gold doesn't lie. Its price is soaring. But why now? Why does a glittering metal in a vault halfway around the world feel like it's whispering a secret? Gold is not just a metal, it's a mirror reflecting fear, uncertainty, and often the cracks in the system we pretend are invisible. Peter Schiff sees those cracks. He spent decades warning about the consequences of excessive debt, unchecked money printing, and the illusion of stability. And now he's saying, when gold reaches these heights, it's not a celebration, it's a signal. To understand why, we need to go back to basics, but stay with me, this won't be boring. Gold has been a store of value for thousands of years. Empires, banks, even ancient traders, everyone understood one truth. Paper money can fail, gold cannot. It doesn't corrode, it's scarce, it's universally recognized. But here's the catch. Gold doesn't move randomly. Its price is a reaction, a symptom. When trust in the dollar weakens or the U.S. Treasury piles debt higher than ever, gold starts moving, slowly at first, then in a sprint. Think of it like a smoke detector. You don't see fire yet, you just smell the first warning signs. Let's zoom in. The U.S. prints money when it spends more than it collects. This increases the supply of dollars. Economists call it quantitative easing. The average person just sees higher prices at the grocery store, but the ripple effect is massive. Debt isn't bad by itself. Countries run deficits all the time. But what happens when debt keeps growing faster than the economy? Interest rates must rise to attract lenders. Higher rates slow growth. Gold shines brightest when confidence in that system cracks. Schiff points out something subtle but terrifying. Each spike in gold in modern history correlates with times when governments overextended and investors sensed the risk before everyone else. Here's where it gets precise. Let's talk numbers, but don't worry, it's straightforward. U.S. debt, $35 trillion. Federal Reserve balance sheet, $12 trillion. Inflation-adjusted return on savings, negative for years. Gold, $2,100 per ounce, up nearly 25% this year alone. It's not just a trend, it's a divergence. The math is uncomfortable. Assets like stocks seem stable. Bonds pay near zero yields. Meanwhile, gold screams protection because rational actors, hedge funds, billionaires, international investors see the imbalance. But let's pause. Headlines love to celebrate record highs. Gold is winning. Investors are hedging. Social media explodes with charts pointing straight up. Reality? The rise is often a symptom, not a solution. Gold doesn't prevent financial crises. It signals when one is likely coming. Owning gold alone won't save portfolios. Understanding why it's rising, that's where the edge lies. So why exactly is gold spiking now? 1. Inflation uncertainty. Prices keep rising faster than wages. Savings erode. People look for shelter. 2. Dollar weakness. As the Fed expands the money supply, the dollar's purchasing power declines internationally. Gold, priced in dollars, rises as a hedge. 3. Geopolitical tension. Wars, sanctions, and instability push investors towards safe assets. 4. Market psychology. Fear breeds demand, and fear is contagious. Each of these factors alone is notable. Combined, they create a perfect storm for gold prices. Let's zoom out. Why should you care beyond curiosity? Gold is a mirror of systemic stress. When it rises sharply, it's a signal the market is nervous, the economy is stressed, or the underlying money system is wobbling. If gold keeps rising while traditional assets lag, it could foreshadow stock market corrections, currency devaluation, inflation shocks, a redistribution of global wealth. And that's where Schiff's warning bites. He's not just talking about gold's price, he's talking about the fragility of the system most people assume is permanent. Here's the ironic part. The very institutions that are driving gold higher, central banks, governments, and major investors, also claim stability. They assure us everything is under control. Meanwhile, the smart money buys gold quietly behind the scenes. It's almost absurd. Those yelling everything is fine are the same ones whose actions confirm the opposite. Imagine this, a metal that can't speak, sitting in vaults quietly laughing at the financial chaos humans create. Meanwhile, economists argue about decimal points and GDP growth as if gold doesn't know the score. The stakes are simple but enormous. Misreading the signals could cost portfolios, retirement plans, or even national economies. Gold doesn't rise just to make headlines. It rises because something in the system isn't sustainable. That's the story Peter Schiff wants us to see. So what now? Buy gold? Sell everything else? Hedge? Panic? Not necessarily. The lesson is subtler, more strategic. Pay attention. Understand the underlying signals. Question stability even when it looks normal. Because when gold speaks, it whispers a warning that the numbers alone can't hide. And the real question isn't whether gold will go higher, it's whether the system behind it can keep holding together. Think of gold as a compass, not a treasure, a warning. And maybe, just maybe, it's time to start noticing the direction it's pointing.
The information provided in this video is for educational and informational purposes only and does not constitute financial, investment, or legal advice. I am not a licensed financial advisor. Investments involve risk, and you should consult with a qualified professional before making any financial decisions.